Hi, welcome to watch the fourth video of corporate finance. Today's topic is capital structure. The first three videos are focused on equities. In the first video, I discussed equity financing. That is, how companies raise equity capitals. In the second video, I presented two valuation approaches that are usually used by underwriters in the IPO process. In the third video, I introduced the capital asset pricing model. The most important model relates the returns on individual stocks or portfolios to the return on the market as a whole. In reality, a firm can finance its business by using both the equity capital and the debts. Now it's time for me to provide you a holistic view of a firm's capital structure, and today's video is the first part of it. The rest will be presented in the next video. Today's video contains three parts. 1. Equity financing and debt financing. 2. Perfect capital markets. 3. Tax, the most significant imperfection. Let's get started. What is capital structure? Capital structure is the relative proportions of debts, equity, and other securities that a firm has on its liability side. A firm can issue many different types of debts to raise capital. The main types are domestic denominated high-yield bonds, foreign denominated high-yield bonds, loans, asset-backed securities. Each debt issue has its own specific terms, which are determined at the time of issuance. Promised payments depicted in those specific terms to debt holders must be made before any payments are made to the equity holders. In that sense, debts are more senior than equities. Equity in a firm with no debt is called unlevered equity. Equity in a firm that also has debt outstanding is called levered equity. Leverage increases the risk of equity even when there is no risk that the firm would default. Hence, investors in levered equities require a higher return to compensate for the increased risk. Holding excess cash can be viewed as having a negative debt. In a perfect capital market, the total value of a firm's securities is equal to the market value of the total cash flows generated by its assets and is not affected by its choice of capital structure. Perfect capital markets refers to a set of conditions. Investors and firms can trade the same set of securities at comparative market prices equal to the present value of their future cash flows. No taxes, transaction costs, or issuance costs associated with security trading. A firm's financing decisions do not change the cash flows generated by its investments, nor do they reveal new information about them. With perfect capital markets, a firm's weighted average cost of capital is independent of its capital structure and is equal to its unlevered equity cost of capital. Financial transactions neither add nor destroy value, but instead represent a repackaging of risk and return, and this statement is known as the conservation of value principle. Leverage can increase a firm's expected earnings per share, but this increase is necessary to compensate for the risk brought by the leverage to the shareholders. Issuing new shares at a fair price will not dilute existing shareholders' ownership. So the bottom line is that in a perfect capital market, a firm's value is independent of its choice of capital structure. However, the real world is not perfect. In many instances, the choice of leverage is of great importance to a firm's value and future success. There are large and systematic variations in the typical capital structures for different industries. Among all the imperfections that have an impact on the capital structure, tax, the most significant one. So, in the next slide, we will talk about debt and tax. Firms pay tax on their profits after interest payments are deducted. Interest expenses reduce the amount of corporate tax firms must pay. The gain to investors from the tax deductibility of interest payments is referred to as the interest tax shield. Though firms do not have to pay the tax on their interest expenses, the debt investors need to pay personal tax on their interest income. So, the effective tax advantage of debts should take both the corporate tax and the personal tax into consideration. As different investors have different personal tax on interest income, it is very hard to estimate the effective tax advantage. Starting in 2018, the limit to the tax benefit of debts is 30% of EBITDA, and the limit drops to 30% of EBIT after 2021. Therefore, the optimal level of leverage from a tax saving perspective is the level such that the interest just equals the income limit. And in reality, most of the companies has leverage that are far under the optimal level of leverage from a tax saving perspective. The consensus of so many managers in choosing low levels of leverage suggests that debt financing has other costs that prevent firms from using the interest tax shield fully. A key cost missing here is increasing the level of debt increases the probability of bankruptcy, and that is what we will address in the next video. Thank you for watching. Have a nice evening.